Welcome. I'm Marja, and this is Money How Europe, a podcast about investing, financial education, and building wealth across Europe. Now, let's find out how. Steve Sosnick from Interactive Brokers, welcome back to Money How Show. It's great to have you with us again.
Oh, it's my pleasure, Maria. Great to see you again.
Today, I would like to focus on Europe, whether Europe equities finally deserve a larger place in investors' portfolios, and how American investors actually look at Europe. But before we get there, we simply can't ignore what's happening in the markets. There's also an old saying, I don't know if you know, if when America sneezes, Europe catches a cold. Do you know yeah. So over
Yeah.
the past So over the past few weeks, we have seen significant volatility in AI-related stocks, particularly semiconductors and memory chip companies. Some well-known market bears are warning that this could be the beginning of much deeper correction, even 70% decline in leading AI stocks, whilst others argue it's simply a healthy reset after an extraordinary rally. What do you think?
Um, I think I think both can be true to some extent. I do think we are resetting. The rally has been tremendous, particularly in semiconductor stocks. The theme of the market has changed. For most of last year, we were buying. The world was buying the hyperscalers, the companies that were spending billions and billions of dollars on AI investments. Then this year, as they needed to go from cash flow positive to cash flow neutral or even negative, people said, wait a minute, if they're spending hundreds of billions of dollars that they need to raise, who's getting all that money? And so we shifted from the people who were taking the technology, taking these products, to the people who are making the products, mostly semiconductors. But those rallies of the type where you have 100% rally in in 2 months are unsustainable. And that's what we're seeing now is when you have rallies that are that sharp and that straight up or parabolic, um, they end unpredictably and they end in a fairly ugly way. And it's bothering me a little bit because people are saying, oh, see, semiconductors are in a bear market because they're down 20%. That's artificial. That means 20% bear market makes sense if you're talking about a big, broad market. It doesn't make sense if you're talking about a specific sector that's been a rocket ship. And so, I think what we've seen so far is basically a pullback to some of the longer term moving averages, but not a break in the trend in the semiconductor stocks. But what it means is, particularly from places like Korea, where there's tremendous amounts of leverage being put on those trades, um, there's there's plenty of room for downside. So what we have now is, I would say, healthy-ish pullback. It's too early to say if this becomes something greater or just yet another in a long series of buy the dip opportunities.
But how do you distinguish a healthy correction from the beginning of a bear market? What indicators are you watching most closely today, for example?
If we start to really break down through some of the longer term moving averages, we try to get back to, let's say, the 50, and it holds for a little bit and then it breaks down to the 100. At some point you run out of moving averages. So I think that's really the question, is does the sentiment shift? And right now I still think the sentiment favors it doesn't favor it, but we still see a lot of people trying to capitalize on every dip. And I understand why, because for several years now, pretty much every dip has been a buying opportunity. So if you're an investor, particularly who's relatively new to the markets, every dip pretty much has been a buying opportunity. So I understand where that logic comes from, but it's not foolproof. Or it's not foolproof, or it can't. Yes, if your time horizon is infinite and your amount of money is infinite, which God bless you if that's true, and I'm pretty sure it's neither is the case. You do have to be cognizant, of your of the reasons why you're investing. Is it retirement? Is it saving for a home? Is it saving for a change in family status? That sort of thing. if you need the money sooner and and have big expenses coming down the pipe. Fortunately, in Europe, you don't have to worry about university expenses the same way we do in the United States, or healthcare worries the same way we do in the United States. But if you have, if you're a young investor who's getting married or wants to buy a new house, you don't necessarily see that every dip can always be a buying opportunity, because at some point you need that money. So, or you're close to retirement. You can't just assume it's going to be there. So,
Mhm. You probably saw the statement from Warren Buffett. He said that we are behaving like gamblers in financial markets. And as someone who closely follows option markets and retail trading, do you agree with Buffett?
pretty much every investment product does start with some reasonable logic, whether it's risk transfer or hedging, or trying to trying to do something productive with the asset. But you know, as we get into options with shorter and shorter dates, where in the U.S. now we have daily expiring options. Um, Prediction markets, I can make a case for why prediction markets are excellent risk transfer measures, or excellent measures of risks that had been hard to quantify in the economy. But I can make that argument for how many people, for what the Fed might do at the next decision, or how many people might dissent at the next ECB rate decision. It's hard to do that if I'm, using a prediction market on what color dress is Taylor Swift going to wear the next time she's at an awards show. So, that's the problem. Cryptocurrency is a whole asset class that, still is waiting for a lot of real world uses. And so if it doesn't have, we can make cases for why there's a point to crypto, and certainly of blockchains. But as of now, they're still waiting for their real world uses. In most cases, they're not part of the mainstream financial world. And so all these things can start to take on they can all sort of converge upon gambling, even though we can argue that many of these things started from a point where there was a legitimate non-gambling methodology. But I think if you take a gambling approach to the markets, and in the U.S., this became very prevalent after COVID, because we had pretty much just legalized sports gambling in most states. It's still not 100% legal everywhere. I don't need to bore the listeners with our domestic politics, but let's just say most states started to enable sports gambling. Then during COVID, there were no sports to gamble on because the world shut down, and a lot of people started to realize some sports bloggers turned into financial commentators, and a lot of their followers picked up on the idea that option trading has, in many ways, a similar characteristic to sports betting. Right? If I'd bet on Spain yesterday to win the World Cup, I would have laid out a certain amount of money, and if they won, I would get some rate of return on that money, and if they lost, I would have lost what I'd put in. If you buy an option, that's really not that much different, right? You lay out a certain amount of money, you hope for a leveraged return, and if not, you lose what you put in. That's that opened up a whole world, and then the meme stock craze came out of that, and I don't, the rest of the history is all out there, but I do think that increase there's always been a certain amount of gambling aspect to markets, let's be real, but I think it's really become much more, as gambling became much more mainstream. I think the convergence with options became much more, and investing overall became much more clear.
So democratization turned into gamification.
Oh, can I steal that? That is wonderful,
That's
Marja. Yes,
great. Yeah.
exactly. Oh, yes,
I was
absolutely. I think you just found the great title for this podcast. I'd love that.
um Okay. What do you think about prediction markets? Interactive brokers also offers in prediction markets. You said you can vote on a Taylor Swift dress, or I don't
Not
know.
here, not here. What we've done is we believe very strongly in prediction markets, and I'm not just saying that because I work here. I do believe in prediction markets as a product. Where at Interactive Brokers we differ from some of the others is that we don't offer prediction markets on what we call entertainment. So you can't bet on Taylor Swift's dress. You can't do sports betting here. We don't offer it. We I will say um, that there's bona fide things that you can hedge that make sense. Again, what is the next rate decision? From one of the world's big central banks, whether it's the ECB or the Fed. You could sort of speculate on that using the futures markets. In the US, you would use Fed funds futures, but it's imperfect and difficult for people to do. It's much more straightforward to basically buy a yes or buy a no contract. And, at a certain level, is there going to be a 25%, is there going to be a 25 basis point hike at the next meeting? I can buy a yes or a no, and that's pretty simple. And that's a risk that I would argue was not necessarily exists to all investors, but is not necessarily easily hedged. And so prediction markets allow you to do that. Climate, those contracts are in their infancy, but I will argue that weather and climate are very important things to hedge for a lot of people, whether it's utilities, whether it's whether it's insurance companies, things of that nature. These are risks that ultimately can do serve an economic purpose. Even the markets right now are not big enough necessarily for an insurance company to hedge their hurricane exposure with necessarily, but for smaller businesses that are weather dependent, yes, I can make a real argument why if I had a hotel by a beach somewhere, and weather might affect the number of people staying in my hotel, I can come up with a reason for that. So we stick to contracts that um, where we see there is a bona fide economic risk or political, but we all know that politics affect markets. So I think that's all part and parcel. Um, the entertainment stuff is a bit murkier. You know, yes, if I, perhaps if I owned a bar in Spain and I was going to offer free drinks if Spain won the World Cup, and maybe I would buy, maybe I could use a prediction market, but that's really second order. There's no major need for that. So we avoid the prediction markets that involve what I would call entertainment, or some of the stuff that a lot of them can be easily manipulated, and we avoid those too. I mean, it's hard to manipulate an election, hard to manipulate the weather. Although, of course, someone in France tried by putting a hairdryer next to the next. This is true. Next
No.
next to the sensor by Charles de Gaulle Airport. But for the most part, these are they're we don't get into the. So I think the key is look at prediction markets the same way. Is if you can see a real economic need at the end of the tunnel there, then we think there's real value to them. If it's just more of a entertainment value, um, that probably that's probably crossed the line.
In which category does Jeremy Grantham warning belongs? Entertainment or economic? Because he said that AI stocks could fall by 70%, and he also suggests that investors should significantly reduce their exposure to U.S. equities. What do you think?
Um, I may not be as extreme as Jeremy Grantham, but I do think we have to. I do think it behooves us to think about, have we gotten ahead of ourselves, and particularly when you have, again, 100% rally in a major sector of the market in 2 months, you have to wonder how sustainable that is. And the where I think Grantham comes from, and this is just economic history, is pretty much every major technological advancement that has helped society. And let me stipulate that all the things I'm going to say have been big leaps forward. Um, they all suffer from overinvestment. So whether it's the internet, whether it's the PC, whether you go back a little bit further and talk about like radio in the 1920s, utilities a little bit before that, railroads, they've all had you know, you want to go even further back to England, the exploration of the New World, the South Sea bubble. So there are every one of these things was a step forward for society. But at any given point, people, you know, the problem is this, Maria, is you don't know what the returns are going to be, and you don't over time. Let's stipulate they're going to be huge, but you don't know when they're going to occur, and you don't know who's going to benefit from that. And so it usually takes longer. And also, what happens is people start to throw money at it because they see the returns at the end of the picture, at the end of the tunnel. But not everyone is going. Here's the problem: not everyone is going to win. But if you don't try, you're not. I can assure you, you're not going to win. There's a saying from North American ice hockey by Wayne Gretzky, whose name probably means nothing to most of
We
your
know
listeners.
Wayne Gretzky.
You do know Wayne
Yeah,
Gretzky.
of course we know that.
Okay, I didn't know that. All right, so Wayne Gretzky had a famous comment. As his comment was, you don't score on all the shots you don't take. Right? I mean, so which is why he scored plenty of goals. So I'll take his word on that regarding ice hockey, and that I think is the philosophy that a lot of people have right now toward AI. You have to be taking the shots right now. I don't know who's going to win, and I don't know how much. I will stipulate that it will make businesses more productive. I can't quantify how much more productive it will make the businesses, and I can't quantify when. Thinking back, let's say, to the internet era, which is technologically speaking, is probably a good analogy. Stock wise, it's different in many ways because because there we went crazy for companies that didn't have earnings or cash flows, and now we are certainly following actual money. But there, what happened was everybody rushed to build fiber. You needed if you were going to be on the internet, you had to have bandwidth. And that was true, and a lot of that bandwidth is still in place. Unfortunately, the companies that laid the fiber are such illustrious companies as Global Crossing, as Lucent, Enron. They're all gone, right? I mean, so the problem was, yes, there was a huge productivity boost from all this. It took a lot longer than people thought. And initially, you had a lot of overbuilding because the capacity wasn't there. So just last week, you had Jamie Dimon come out and make a comment saying, yeah, I see the AI could be productive, but as of now, we're not really seeing it in our bottom lines yet. And I think that, until regular companies can see this, it means that we do run the risk of getting ahead of ourselves because it can't just be money sloshing after more money. Somebody's got to be finding this to be a more productive tool that helps the bottom lines of companies. And the other thing to remember about the internet is the early winners were not the ultimate winners. If we had this conversation in 1999, I would be, well, we couldn't have it because the internet in those days wouldn't have allowed this. But let's just stipulate that if we were having a conversation about the internet in 1999, I would be discussing my compact computer and my AOL login and my Yahoo search engine, things of that nature. And bear in mind that Google and Facebook didn't exist yet, right? So the technology moves, and we get reminders of it. The latest being moonshot out of China, but uh, I don't know who's going to be the winner. I don't know if it's going to be an American company, a European company, a Chinese company, or some kid in a garage in Senegal who invents. I have no idea, and that's part of it as well. So to Grantham's point, the more um, the more extended we get, the bigger the risk, the bigger the potential pullback becomes. Um, and I do think that there is. It's important to remember that history has dealt us a lot of bad hangovers after the initial excitement, as it took time for society to digest the initial excitement and turn those into profitable bottom line productivity enhancements for not just the companies providing it, but for the companies using it.
So the world's largest technological companies will report earnings reports, I think, by the end of this week, most of them. So what will you be watching closely?
When you think about it, markets are forward looking. Once they report those numbers to you from the prior quarter, that's looking backwards. So what so I think the markets are very excited about guidance. Can this keep can you know will the money keep flowing? So I think from the big hyperscalers, are they going to keep spending money like this? Because as we've discussed, so many important trades are based upon these companies just continuing to spend money constantly. And if there's any slowdown in that, that's going to be problematic. I think also, I do have to wonder whether expectations have gotten too high. I think for the Mag 7 in those companies, they're not necessarily too high, but for some of the smaller companies, particularly what I would call the makers, the semiconductors and other companies that related, let's say like um, Corning Glassworks or Nokia, things of that nature, companies that are also benefiting from AI spending. Um, we've seen we've seen the markets not react well even to really good earnings from some of these companies. Go back to Nvidia's last earnings report, which was last cycle, but a month after the main earnings season because they're a little bit off. They reported great earnings, great guidance. The market yawned. Then Micron Technology came out. Great earnings, even better guidance. Stock sold off. Samsung, same thing when they came out a couple of weeks ago. Looking back to last week, ASML, same thing. The market said, "Oh, okay, that's nice," and it had a nice little rally for doing terrifically. And then Taiwan Semi, same thing, and the stock sold off. So I start to worry that all right, we're on a little bit of a sports theme today. It's like, think about Olympic pole vaulting or high jumping. Eventually, the bar gets set so high that even the best jumpers can't get over it. And so I do get concerned that the market has set the bar so high that it becomes difficult. And the other question I raised after NVIDIA's, after people yawned at NVIDIA was, who is left to buy NVIDIA? So yes, they report these great earnings. Is it going to induce more people to come in and buy NVIDIA? Is it an unknown story at this point? Are any of the stocks I've mentioned unknown at this point? Of course not. Everybody know whether it's NVIDIA, Micron, Samsung, ASML, Taiwan Semi. You're either in them or you're not. And so I don't know that even great numbers are going to move the needle too much, whereas poor numbers are going to get people very nervous. Look at IBM last week, where they had a bad report and the stock plummeted 25%. Here's the other thing to keep in mind, even with IBM. I happened to have the day off when they reported, and I was listening. I was in the car with my wife driving to the beach, basically, and one of the people I still was listening to the financial news because I had to go back to work the next day. And one of the people said, "See, they're getting rid of IBM, like it's as they don't want to look at it anymore. They can't stand it, and and it's back down to the lows of May. It's like, wait a minute. My wife actually picked up on it. My wife was like, picked up on this at the exact same time. She's like, wait, they're talking about this stock getting absolutely hammered and nobody wants to own it anymore. And all we've done is given back 2 months of gains. That just means that we had a crazy rally based on hope, not reality. And so that's where I start to get a bit nervous because there's a lot of room for some of these stocks to pull back sharply, yet still not have broken big trends. And I think that will spook people if that happens in a big way.
So you're talking about how media creates headlines and sentiment in the market. Actually,
Yeah, yes, that's true. I mean, to some extent, I think also I don't. I'm not a blame the media person. I wouldn't be talking to you if I blamed the media for things. I like the media. I've met in my job. I've met a lot of media people from all over the world, and there's very few who I would openly criticize. I think most of them really do their job well and are genuinely nice people. Um, what I what I would caution against is sometimes the media builds up its own hype, and I think about particularly some of the IPOs that have come out recently. I think it's very common, particularly in U.S. media, for them to, if not outright say that it's going to be a hot IPO, imply that there's a hot IPO. Oh yes, and it's everybody's watching SpaceX. Everybody's waiting for SpaceX. Everybody's waiting for SK Hynix. And to some extent that becomes self-fulfilling, right? Because if I keep hearing how everybody is waiting to buy, if everybody's looking forward to the SpaceX IPO, I'm going to start looking forward to the SpaceX IPO just because I have to keep an eye on it. Same with SK Hynix. The 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 company, both these companies did very well out of the box. I think that was just retail not getting as much as institutions, and that's sort of the normal IPO, post IPO move. In the case of Hynix, they were paying a huge premium for the ADRs vis-a-vis the local shares in Korea. And Korea is not the easiest market for international investors to access, except if you're with Interactive Brokers, who does allow its customers to invest in Korea. So I wrote a piece last week saying, guys, if you want SK Hynix, um, yes, it's much easier to buy the ADRs, but perhaps you might want to look at buying them in Korea where you're paying 30% less for the same shares, for the same exposure. But this is what happens. People, and now we're also getting into, and this goes to your earlier point about gambling, uh, the volatility in these kind of moves has attracted a lot of leveraged ETFs to the point where in Korea they had to actually stop them because there are too many, and where people are buying double levered exposure on single stocks in the U.S., triple levered exposure on certain indices in the U.S. And again, I wrote something last week as well, just that maybe 2 weeks ago, of you have to understand some of these products because even their sponsors say that they're not investment vehicles, they're trading vehicles, and yet people invest in them. And so there's a lot of froth going on, and I'm not going to blame the media for it, but the problem is it becomes self-fulfilling. If there's a story out there, the media reports on it. If enough people click on that story or pay attention to that story, the media reports on it more. So it becomes self-fulfilling. Again, I'm not going to blame media. That's just not I don't believe in
I
that. I do
understand.
think, but I see where you can see how that snowballs.
Snowballs, yes. One more question regarding American dollar. For European investors, the dollar is almost as important as the stock market. How do you see the outlook for US dollar over the, I don't know, next 5, maybe 10 years? Okay, 5 years. 10 years is maybe too long. We don't know what will
Maybe a
happen.
bit much. Let me just give you. I think a lot right now. A lot of the interest in the U.S. dollar is that there are a lot of expectations of rate hikes priced in. There's also a bit of a I hate to call it a safety premium, but at this point, we are an energy producing country, and the eurozone, with most exceptions, is not. For the most part, the oil that comes out of Europe are two non-EU currencies, whether it's the Norwegian kroner or just to some limited extent the British pound. Um, so those factors are both working in favor of the dollar right now. I'm not as convinced that the Fed is going to raise rates to the extent that I think the market does. Markets always expect more from the Fed in either direction than the Fed gives them. Think of how many rate cuts we were pricing in for all that time. That just didn't happen. And I think Kevin Warsh, although although he clearly wants to fight inflation, and he clearly wants to reduce the size of the Fed balance sheet, both of which would bias toward the dollar. It's not clear that he's going to rush to raise rates. His boss certainly does not want him to raise rates, and so I think the standard for him to do so is quite high. And so technically, by the way, it's not his boss. Technically, the Fed is independent, but let's
Yeah.
be real, the person who appointed him probably demanded some assurances. So, and also, I think we've kind of forgotten that, earlier, just a few months ago, the trade was avoid the dollar because people did not want exposure to the U.S. And I won't get into the politics of it, but I would argue that starting a war in the Persian Gulf is probably something that would not, put the U.S. in great favor, in most of among international investors. So I think it's very murky. I think right now the dollar is in a bit of an uptrend. I don't know that it persists too long, and maybe it means I should try to, if I take a vacation, I should probably take one in Europe while dollar's strong against the euro, or stronger, or even stronger against the yen. Go to Japan, but I'm going to Canada for my vacation where it's not where it's not as strong. But the but basically, I think the dollar has probably got a bit of a bias to it as long as energy markets remain a bit uncertain, and as long as AI remains an investable theme. We can argue about how long that's going to either of those trends are going to persist, and whether or not it starts to shift back to the prior the prior sort of mindset of international investors maybe wanting to diversify away from the U.S. And look to better values in stock markets elsewhere, and where this perceived interest rate advantage might not come to play as quickly as people think.
And is Europe maybe interesting for investing for American investor, professional investor?
Yeah, it depends if you like value or growth, and this is why Europe had its moments. And I think U.S. investors have to look at Europe, and global investors have to look at Europe. The 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 Right now there's this big dichotomy, this big, yes or no, value versus growth, and I think that's a bit arbitrary. But basically, the names that we've been discussing for the most of the part this call have been growth stocks. All the mental energy is in growth stocks. All the mentality is in growth stocks. Europe is a value play. I've mentioned two European names on this call, both of which were growth stocks. I didn't mention, I mentioned ASML, I mentioned Nokia. The rest, which is not to say there aren't growth stocks in Europe. Let me be very clear about that. But for the most part, international investors, North American investors specifically, think of Europe as more of a value play than a growth play. And so I think if value investing comes back into vogue, and by the way, I think value investing always plays a part in someone's portfolio. I think you do yourself a huge disservice if you don't pay attention to valuations. Europe, there are a lot of compelling valuations in Europe. The problem, that I get into right now is we are so enamored with momentum investing. And at its root, momentum investing says, I'm watching the trends. I'm watching. All I'm watching is price trends. All I'm watching is movement. I'm not paying attention to valuation. And you get into big valuation extremes if you're purely momentum driven. And I think that's how we've gotten to some extremes, is because people just chased trends. If you want to be a bit contrarian, if you want to be focused, if nobody is focusing on valuations, maybe that's a really good time to be focusing
Maybe
on valuations. And that's where Europe comes into play.
go against the crowd.
Exactly.
Yeah. And in today's environment, how important are dividends in driving long-term total returns? Because Europe offers dividend yields of around almost 4%. That's almost double those of S&P 500.
This again goes back to the value versus growth. In my mind, I like getting dividend checks. It's nice to see money just sort of, enter my account. And so if you can get value and dividends, that's a nice thing to have. But again, companies that are fast growing tend not to pay too much in dividends. They will do buybacks. If they're returning money to shareholders, they'll do it via buybacks because they're paying. And the reason for that is not as altruistic, I think, as people think often. They're doing it because they're paying their people in stock and stock options. And when they go to sell their stock, that dilutes the shareholding. So they then take the money and buy back the shares that their employees have been selling. So a lot of it is doing it that way. But right now, if I'm Alphabet, who's got to go out there and raise $85 billion in stock and 20 billion in bonds this month and however many next month, I'm not going to be paying a lot of dividends. The bet there is that they will turn that into even more growth. And so that's why the growth, it comes back to growth versus value. I think every investor should have value, should concern themselves with value, not necessarily be all value investing all the time, nor should you be all growth investing all the time. But I think, a high dividend provides you a cushion. If the stock you're holding is paying you 5% a year, you're getting paid to wait. It's not as sexy by any means, but I think you always have to take dividends into account. I think investors lose sight of that, especially when they're just focused on growth and fast-moving trends.
Maybe you could also invest in treasuries, U.S. treasuries, bonds for 4.5 or 5% long term. That's also stimulating.
Yeah, and I prefer the shorter to the short to middle of the curve, because I think there are going to be some debt issues, some issues with us, having cut taxes so dramatically that that once something's got to give, either we have to raise taxes or we're going to have, or people or investors are going to demand more for longer term bonds. So I prefer sort of 2 to 5 years, especially when the market is pricing in rate hikes that may or may not come as quickly as people think. But yes, this is what comes back. This is where I come back to, cash flow needs and what do you need the money for? There's something nice about getting a rate of return on your money. Nothing is guaranteed in life, but that is more likely than not to remain steady.
Let's make it practical. If you had 100,000, I don't know, dollars or euros to invest today with a 10-year investment horizon, how would you allocate that money between U.S. equities and European equities? Give us a percentage.
I think it depends. Some of it depends on where you live, right? Because if I'm a European investor investing in the U.S., there's a currency play implicitly, and same other, and vice versa. If I'm an American investor investing in Europe, there's a currency play there. But I'm going to be a little more broad and say I would probably allocate. I don't normally do formal allocations. This is kind of fun. I would probably, in my mind, given my age, I'm not a young man anymore, and I have to think about capital preservation maybe a bit more than someone who's in his 20s or her 20s. I think for someone, let's say in a mid to late stage of life, I think you probably want, I think, although people are saying 60-40 portfolios are dead, I
Yeah.
don't think they're dead. Maybe I'll call it 70-30 right now, but probably somewhat 60-40-ish bonds versus, and I would probably do a global allocation of bonds, sort of roughly matching, having some exposure to currencies outside the U.S. And within the 60 to 70%, at this point, I'd probably be half value, half growth, and that's a very rough way because again, it's in some ways an artificial construct. But let's say value versus growth. And so within the value sector, I'd probably be more heavily weighted in Europe because the values are better. In
And
terms of the
which
growth, I'd probably be more heavily weighted toward the U.S. because that's where the action is. But I would not overlook the growth stocks that are in Asia or in continental Europe.
and which three sectors or four, I don't know, would receive the largest allocation in Europe?
In Europe, I think I would go with basically multinational manufacturers. I still think that it's hard to rule out some of the big European companies, whether it's Shell, whether it's Siemens, whether it's Unilever. These companies they're not going anywhere. They haven't gone. They haven't. They've been on the scene for hundreds and hundreds of years, and there's a reason why they persist. I mentioned Nokia. I do actually own Nokia, and I regret that I didn't sell my Nokia because when it was up at around 14, 15, I was like, "What? This is crazy! I've had it since it's five, and it just sat there for years at $5 or $6 a share. Why didn't?" So, but again, I think that, but to me, that was an interesting play because it was a cheaper way to play some of the trends that were happening. That's not a recommendation for Nokia, by the way, especially since I mentioned I regret not selling it. But um, but but I think that a lot of these the big European manufacturers that have had a history of long-term, multi-decade success are where I'd be thinking. I don't know that I would chase some of the luxury names out of France because I'm not enough of a fashionista to know whether I should be looking at Louis Vuitton or Hermes or whatever it is. I don't know. So I'm going to stay away from that, even though that gets exciting. And I know that defense stocks had their big run. I think I'd start to look at those on pullbacks because I do think that, considering our president's comments about NATO and things of that nature, I fully understand why European governments are looking to focus more of their defense spending on Europe. I think they got, like, as with every other momentum trade, they got way ahead of themselves. But I think Europe does basic industry really, really well, and I think that's basic. Whether it's consumer or or more business to business. That's these are the companies that have are pillars of the European economies.
And what do you think about European automakers? So they trade at relatively low valuations. Is this a value opportunity or a classic value trap?
Some of each, unfortunately. Now, I mean, if you compare them to Tesla, they're all cheap, but the market isn't valuing Tesla as a car company. We can have a whole hour show on whether they should be doing so, but let's just say that's a bet on an Elon Musk-led future, not the car industry. The problem I do have, though, is it's still tricky right now because the Chinese EVs do pose an existential threat to a lot of global car manufacturers. We can argue to what extent they're being subsidized, or et cetera. But I think right now there's a reason why the car industry is in a little bit of flux. The U.S. we don't let the Chinese EVs in right now. In America, despite higher gas prices, loves the idea of trucks, which the idea of someone in Central Europe driving around in a big American pickup truck seems insane unless you actually have to transport large amounts of goods. Why would you do such a thing? Whereas people here just drive them because they like them. So, Europe is sort of caught, the European manufacturers are sort of caught in a bit of a bind. Now, I mean, the world loves its BMWs, the world loves its Mercedes. It loves the specialty manufacturers. There's always going to be a 12-year-old boy somewhere with a picture of a Ferrari on his wall that he's dreaming about. But
Yeah.
in terms of some of the other manufacturers, I think they run the risk of being value traps. Doesn't mean they can't earn their way out of it. Doesn't mean they can't be good. But I think there are some existential risks that are being priced in that are not wrongly being priced in necessarily.
One final question. What if we wake up tomorrow to another major market sell-off? What should we do? How should we react?
Well, what you should do in advance is make sure that you are not over leveraged, because leverage is wonderful on the upside. It is painful on the downside. And leverage makes you do things that you don't want to do. It makes you sell. It makes you sell into falling markets. It makes you panicky. It makes you nervous. So first and foremost, check your risk. Do a gut check. If last week gave you some trouble, made your stomach turn a little bit, you're carrying way too much risk because the S&P 500 is 2% off its highs. Let's be realistic. Yes, certain sectors had big moves down, but it means you're probably not diversified and you're not carrying too much risk. If we do fall out of bed, go back to your valuations. Go back and see, are these companies cheap? Or if you're a momentum investor, are they still holding their longer term moving averages? So, that sort of depends on your investment style. But I think first and foremost, check also another thing you could be doing right now is checking your holdings. Let's say you invested, in that $100,000 portfolio, you invested 25,000 in US tech and 25,000 in other places. Well, you're not going to have that same weighting that you started with because the tech shares are going to be such a bigger part of your portfolio. That's what I call a good problem. But you may want to be thinking about how do I get what do I want my asset allocation to be, and does my portfolio match that? And within that, am I taking too much risk? Am I employing leverage that makes me uncomfortable? Things of that nature. So that's how I would approach it.
You have to approach it with, psychological strength to survive this volatility that we are witnessing currently.
Don't panic. And
Don't
the key is
panic.
don't panic. And the
Don't
problem
panic.
is if you have a lot of leverage forces you to panic because you owe someone money and the assets that are backing that loan have gone against you. If
I
you're
think I think Slovenians don't use leverage as much. I think they invest mostly in ETFs, globally diversified, and that's it. If I
then
look at retail investors
yeah,
here in Slovenia,
then just keep your head. If we have
just keep your head.
keep your head. But before I give that advice, there's a couple of things you should always be doing, and again, that is checking your asset. Are your asset allocations where you want them to be? Are you if we've had a bit of a pullback, has that bothered you, or has that just been okay? I can deal with that. I forget who made the comment. I think it was Jack Bogle from who founded Vanguard. Was if you can't withstand a 10 to 20% drawdown, you shouldn't be in equities. I don't know if I go that far, but drawdowns do happen. I know we get lulled into them. We haven't had one in a while, but they do happen, and they don't always resolve themselves so quickly. In COVID, we had a big drawdown, but the world's central banks plowed money into the system. If we have a garden variety downturn, call it 10, 20% correction, I don't know that the world central banks are going to react to that. And so I think just keep your risk, make sure your risks are managed, make sure you sleep well at night when the small downticks happen, because it'll help you sleep better big downtick when the big downticks do occur. And they do and will occur. I just can't tell you when and how much and from where.
So keep calm and carry on.
Yeah, the British had it right.
Steve, thank you very much for joining us again. It's always a pleasure speaking with you.
Same here. This went so fast. It was wonderful speaking to you. Take care, Marja.
Take care.
Bye-bye.
Bye bye.